In this video, I'm going to show you how to write options contracts, collect premium, and generate a consistent return year on year. So on the screen, we're looking at the Tasty Trade brokerage platform. This is the broker that I use. However, whichever broker you're using, it'll probably look fairly similar. So to begin with, what we want to do is we want to hunt for volatility, right? We want to short volatility, basically. And the reason for why we do this is because fear is overstated in the market, and that is consistent. For as long as humans will be humans, fear will always be overstated in the market. That's just human nature. That's our edge, and we're going to capitalize on that by shorting volatility. And the vehicle we're going to use to do that is options, specifically selling the options, not buying the options, but selling the options. So the first thing we want to do is we want to have a look at a list of securities. So pull up your watch list. You can use whichever watch list you want. Right now, I've got Tom's watch list up. What I like to do is just filter from high to low, implied volatility rank. What you can also do is you can click this filter thing here, and you can make sure that you're not showing any securities with an earnings date within a specific range. So for me, I've just got 59 days right now. That's just because of where the cycle is. So 29 days is a bit too short. The next cycle is 57 days, so I've just gone 59 days. So what you want to do is you want to make sure there's no earnings during the entire contract period. And the contract length is going to be about 45 days, up to 45, between 40 and 60 days. We want to try and target 45. That is the optimal time. That is when theta decay begins to steepen whilst keeping gamma risk a little bit away. So you're getting the best of both worlds. That is the optimal start time for your contract. Having said that, we do sometimes sell weekly zero DTEs, but as a general rule of thumb, for the backbone of your portfolio, 45 DTE is where you want to be. So we've filtered out, we've made sure that there's no earnings during the period of the contract, and we're filtering from high to low volatility. So now we just go through the list. So, assuming we're not going to be trading futures, this is just the VIX futures. So next thing here is 96.2 implied volatility rank is United States Steel Corporation. 96.2 is a very high IV rank. So that passes our first check. So let's just take a look at the chart for United States Steel. Okay, so we are looking at the United States Steel Corp chart right now. And we can see the implied volatility rank plotted on this chart below as well. And this is all we need. We don't even really need the chart to trade. However, we're going to just have it up anyway. So we can see here that the implied volatility rank is quite high relative to where it's been previously, hence why it's at 96.3. We can also visually see it here. Price, where it is, doesn't really matter too much. Some people would favor this slightly more because it's recently come down a little bit. But to me, we are non-directional and we trade non-directionally. We're not trying to guess where the market is going to go. So we can see here that the IV rank is high. So let's go to the next stage of what you want to do. So we want to be 45 days out, right? We don't really want to be on one of the weeklies as indicated here by the W's. We want to be in the monthly cycle. So the next monthly cycle, or the closest monthly cycle expiration, is 29 days away. That's a bit too short. I'd rather go to the next cycle out, which is 57 days. Okay. So now what we want to have a look at is the liquidity, right? With the liquidity, the strikes, the deltas, etc. So in this column here, we've got delta, and then obviously we've got the bid and ask and then the reverse for the put side. Call side on the left, put side on the right. This orange bar here is the expected move of the underlying within the 57-day period. And what we want to do is have a look at the spread first of all. So let's go closest to the money. Here we've got a bid at 2.69 and then an ask at 4.15. So what we can see here is this is a very wide spread. Okay, we'd only want it a couple cents wide. So this is very wide. And the reason we don't like this is because every time you get in or out, we're just going to be paying that spread essentially. So yeah, we actually would not trade this, even though it has a very high IV rank. We would not trade this because of the spread. So if we go to SPY, for example, and we look at the spread here, we got 13.75, 13.77. They're pennies wide. It's only a couple of cents wide. It's very tight liquid markets. That's what we want to be looking for. So X did not pass that check. So we go down further. This is gold futures. We're not going to be covering futures in this video, although it is very similar. We've got GLD. GLD is a gold ETF, and we can see here that it has an IV rank of 75.1. Because it's an ETF, obviously it does not have earnings, so that's also okay. So we go to the next stage here. I do happen to actually have a position on live on GLD, but that's okay. So we're going to go to the 57 days to expiration level here, and this is just showing you my current position that I have on with GLD, but that's okay. So what we want to do is want to have a look at the spread. So as we can see here, obviously it's not as tight as SPY. However, it is still fairly tight, and this for me is okay. As we can see, it's about 10 cents wide. It's not best, but it's not that bad either. So what we want to do now is we want to sell some contracts, right? What contracts do we sell and where do we sell them? Very simply, as a rule of thumb, we want to sell one call, one put, right? One call, one put. Very simple. Where do we sell the call? Where do we sell the put? So on the call side, let's start with the call. We want to go out to about a 16 delta, right? Which is here, which is the 247 strike, right? So we want to sell this contract here, and then we can do the same thing on the put side, find the 16 delta and sell it here at the 216. So as we can see here in the bottom right hand corner, we can see we've got the 216 and 247, and we're going to be selling these or writing these. Whether you sell a contract or write a contract, those terms are interchangeable. It means the same thing. Okay, so what does that actually mean? What are we doing? So basically, it means that we don't want price to go above 247 and we don't want price to go below 216. We've created a range, right? 216 and 247. So if you go into the chart, 216 is about here and 247 is somewhere up there, just above there, right? There basically. So 216 and 217 and 246. 247 and 216. Right, cool. So that's our range, right? This is where the price currently is, and we can see the range is kind of like roughly about there, and we basically want price to stay within that range, okay? And that, in a nutshell, is what these contracts are here. Now, if the price moves above or below that range, then we begin to lose money, right? If it stays within that range, we make money. It's a bit more complicated than that, but in a very simple nutshell, that's how it works. Now, what is the chance of that happening? Well, we've got a probability of profit here of 74%. So 74% of the time, the price is going to be within that range at expiration, which is 57 days from now. Now, okay, so we understand that concept. So we're taking on risk, right? So that means we need to be taking on a reward. So what reward, what are we getting paid for this, right? Well, that's what this number is here. This is the premium on both of those contracts. This is $2.57. Each contract controls 100 shares of the underlying. So that would be times 100. So that's $257, right? We would get paid upfront $257 to take on that risk on those contracts. Now, in order to have that position on, there's something called buying power, and the what your broker will do is they will lock up money in your account to cover the worst case scenario. Basically, and that is indicated by this number here, 3,554.20. That is how much money in dollars is going to be required by the broker to cover you in the worst 5% of cases. Okay, and in exchange, you're going to get paid $2.57. Okay, your max loss is unlimited. However, there are ways to manage that risk, and in reality, you will never actually take a max loss or anything anywhere near that. So we collect a premium, we tie up capital, and that's basically it. And once you've done that, you'd press review and you send that order, and then you get paid $258 or $257, whatever price you get filled at. And that money will be tied up by the broker until you close that position out, or those contracts expire worthless. Now, what you can do is you don't have to wait until you get to expiration. Let's say, for example, if halfway through the contract you collect half of the premium. Well, if you were to take profit at 50% of 257, you've got an 88% chance of hitting that as opposed to 74. So this is a very high probability trade, right? Very high probability trade. Now you're probably wondering why. Well, you're probably wondering, this is actually a lot of capital. So you're probably now wondering, $257 you're bringing in, and you're tying up $3,554. This is a big number, and not everybody can tie this up because, if you've got, say, a $5,000 account, you wouldn't put 3.5K on one position. That would be insane. So what you can do is you can buy other contracts. So you sell these. So for example, on the call side, you sell this call at 247. And let's say, for example, you go $5 wide. So 1, 2, 3, 4, 5, and then you buy this contract here at 2.6. Sorry, no, that's not right. We're just gonna have to go $3. We're just gonna have to go $3 wide because it doesn't go up linearly. So this is now $3 wide, right? Or do you know what? We can just go $2 wide. It's fine. $2 wide on the call side, and then let's say we do the exact same thing. We go $2 wide on the put side, right? 216, 214, 247, 249. Now, what's happened here is we're selling this, and then we're buying another contract lower down, right? Still a put, and on the call side, same thing. So 2 calls and 2 puts. Now, what this is doing is this is limiting our loss. So we've not got an unlimited loss potential anymore, right? So without this protecting us, if price was to go above 247 and it just keeps going, we'll just keep taking a loss. However, with this protecting us, our loss is limited to between 247 and 249. So above 249, we don't take any more loss. We've taken our maximum loss, and then the reverse is true on the put side, right? Hence why we've got a max loss here. And we still can take in 50 cents, right? Which is $50. So you're risking $150 in buying power now, and you're bringing in 50, right? So as you can see here, this is a much higher return on capital trade. So if you have less money in your account, you can turn what we had previously, which was a strangle or a naked position, we can cover it reduce the buying power required, and get a higher return on capital, and we can more aggressively grow smaller accounts. Now, this higher return on capital doesn't come for free. We have to give something up. So what we're giving up here is we've got a lower probability of profit, both for holding to expiration and for whether you take profit at 50%. That's the trade-off here. You get a higher return on capital, but you have a lower probability of profit. There are other trade-offs as well. For example, data decay won't be as aggressive. But we don't really need to worry about that. This is just a very basic overview. I'm assuming you already know what a call is, what a put is. If not, Google it. And that's it. So this position would look good to me. I'm not actually going to put this position on because we already have an existing position on. But you just review and then send it off, and then the money would be credited to your account. And that's it. There you go. That's a position, and you just simply do that over and over again on different underlyings, diversified underlyings, and you want to stay delta neutral. So the reason why we go with a 16 delta is because delta basically tells you the probability of the price of the market basically staying out of the money, staying away from that contract, right? Staying within that range essentially. So a 16 delta on both sides means 32% chance in total, which then means you've got a 68% chance of it not going outside of that range or expiring outside of that range, and you've got a 32% chance of it expiring outside of that range. So that's why we go with a 16 delta. 16 delta is the one standard deviation mark, and it works really well, especially with 45, 60-day expirations. So that is essentially how you do it. So whether you've got a larger account, whether you've got a smaller account, that's how you do it. And you can widen the spreads and adjust your credit that you take in and the amount of buying power that you put up. So this is just a little look at some positions that we have on currently. So before we go through these positions, let's have a look at position sizing. Okay, so this is a position sizing template. I'll show you all at the end of the video how you can get access to this template. But basically, you simply put in your portfolio size, what the VIX level is currently at, and then it will go ahead and tell you exactly how much you need to, what the maximum amount of money is that you can put on any single position, whether it's undefined or defined. Undefined is naked, defined is covered. At the end of this video, I'm going to show you exactly how you can get yourself a copy of this position sizing template. But for now, we're going to crack on, and we're just going to have a look at some positions that we've got on right now. So as you can see, we've only just put these positions on a couple of days ago. We've got 57 days left. So there's not really anything to do management-wise. But by all means, we can still just have a little look and see what's going on. So we can see here Intel and the semiconductor ETF. We can see those two positions are doing quite well. With the semiconductor ETF, SMH is an iron condor, Intel is a strangle. UAL seems to be hovering around break even. That's a strangle. We got CMG. CMG seems to be struggling at the moment. Let's have a look at CMG. So CMG is a strangle. 45 and 60 is where our strikes are at. So we've got 45 and we've got 60. About there. So we've got 45 and 60. Price is currently at 53. Coming up to 54. So right now, price is perfectly in between our range. Obviously, price has moved a little bit, but that's okay. Price is always going to move. As long as it stays within this range, it's fine. So as we can see here, we are currently down a little bit, but there's nothing actually wrong with the position. So when you do have positions on, don't be worried if you see red in your position dashboard. As long as your strikes haven't been breached, as we can see here, our strikes clearly have not been breached. the position's working. It's fine. Don't get stressed. Relax. Just let it work. Let theta decay do what it does, and let that work in your favor. And that's basically it. You manage your positions accordingly, according to the position template. You put on strangles, you put on iron condors, exactly how I've just showed you in this video. You hunt for high implied volatility. You make sure everything's nicely diversified. Um, and if you do that, you will be profitable. You can do things to even boost your return even higher than that. For example, you can close positions early, say close at 50%, close at 25%, increase your win rate, reduce your gamma risk, um, and overall you will have a higher daily P&L. You can also make adjustments. We're not going to go through all of that in this video. However, all of those things are bonuses and they will boost your return. However, just by doing what I explained in this video, this is enough to make money long term, pretty consistently. Now, for anybody who is wanting to learn more about how to do this, about how to make sure you're doing it correctly, whether you're new or whether you do already have some experience, there will be a link in the bio, launchpass.com/EDS/premium. You can just go click in the link in the bio below and you will be taken to this page. We've just launched this paid Discord community. Right now it is £1 a month. This is obviously going to be going up, but because we've just launched, it's near enough free right now. You will be given full access to our portfolio, both for smaller accounts and larger accounts. So it doesn't matter where you are, you can just copy our trades if you want to. Whilst you're copying, there is a full in-depth course going through everything that you need to know start to finish. That's included in the Discord as well. So whilst you're learning, you can also be earning by copying our trades, and then put the two together and expedite your learning path, basically. We also, obviously, it's a Discord group, so you can speak with other people who are on the same path as you, and we can all just discuss. You can speak to me directly, and there's a 100% money back guarantee. So once you study the entire course and you followed our trades for 6 months, if you haven't been profitable, we'll either work with you for free until you do, or you can request a full refund. It's completely risk-free. And like I say, right now it is £1 a month. Every 5 people that sign up, the price is going to increase until we hit a market equilibrium. So you are rewarded for getting in early. Whatever price you get in at, you are locked in at that price. When prices do increase, you will not feel any price increase. Your price is locked in at whatever price you got in at. Right now it's £1 a month. So that's everything. I appreciate you sticking with me. If you have any questions, please do let me know in the comments, and I'll see you guys in the Discord.